Okay, we're going to begin now. Hi, everybody, and welcome to today's discussion addressing major issues facing the midstream industry, hosted by the Center for Midstream Management and Science at Lamar University in Beaumont, Texas. My name is Thomas Kalb, and I'm director of the Midstream Center. This webinar is the first of 4 in the Midstream Center's 2022 series on the midstream industry. All webinars are recorded and can be found on our website. Just go to lamar.edu/midstream, lamar.edu/midstream, and click on the News and Events tab. Today's program will be a 1-hour Q&A session with our panelists. On our panel today, we have Juan Cardona. He is Senior Concept Development Engineer at Summit Midstream Partners. He brings a decade of experience in the midstream oil and gas industry, where he has managed several facility standardization efforts to enhance the viability of oil and gas midstream projects. His primary focus is new products and new application development. He earned an industrial engineering degree in 2010 from Lamar University, is a certified Six Sigma Black Belt, and a senior member of IEEE. Also with us is AJ Chandra. He is CEO of Muse Stansel & Company, where he also leads the midstream and independent engineering practice areas in the Houston office for the firm. Mr. Chandra joined Muse in 2014 after 28 years of experience in various facets of the midstream industry, including operations, engineering, business development, management, and consulting. Mr. Chandra has a wide variety of assignments covering all aspects of the energy industry during his career, and has had several long-term expatriate assignments overseas, including Europe and Southeast Asia. Mr. Chandra's operating, consulting, and management experience includes working at Amoco, Purvin & Gertz, Hess, and Next Era Energy Resources prior to joining Muse Stansel. Finally, we have with us Greg Toth. He is Director, Acquisitions and Strategic Planning at Plains All-American in Houston. Greg began his career at Plains 10 years ago and has responsibility for evaluating acquisition and joint venture opportunities, and is also involved in Plains' fundamental efforts regarding basin level production forecasting and pipeline balances. Greg graduated from Southern Methodist University with undergraduate degrees in finance and economics. For viewers, we are not taking live questions, and so make sure your microphone is muted and your video is turned off. If you have a question, please use the Zoom chat box, and if we have time, your question will be read and answered. Okay, now let's get on to our panelists and the midstream topics of the day. Our focus topics include, first, attracting and retaining young talent; second, capital markets; and third, energy transition. If we have time, we will take a look at aging infrastructure. AJ, please give us your views on attracting and retaining young talent in the midstream industry.
Well, thank you very much, Tom. Great introduction. Hopefully everybody on the call is interested in the topics that we want to talk about. So I'm kind of the old guy on the panel, I guess. I've been in the industry about 35 years. And every few years, we kind of go through this whole process of talking about the young folks that we need to bring in. And you know, I'm a whole lot closer to the end of my career than at the start of my career, but this is a really exciting time for young folks to come in. The problem we've had over the last 30 years is a couple of things. Is one, we are a very cyclical industry. So a lot of folks don't look at us for the long-term career that, you know, if you're in your 20s or early 30s. And then, of course, the last few years, oil and gas hasn't really, you know, had a great reputation. You know, even the kids I talk to in college, they want to go to work for an EV car manufacturer as opposed to work for a dirty old oil company or something like that. So we have those two issues, and reputation and some of the things associated with that are probably part of our biggest issue. But the bottom line is we have to attract the younger talent, because we do have a lot of folks that are probably within 5 to 10 years of retiring. And what I say for the folks that we want to get into the industry is, I don't think they understand how high tech our industry is. So while they all want to go, you know, again, younger folks want to go to all these high tech pieces and work for the Googles or the Amazons or the Teslas. We have a whole lot of stuff in pipelines, in robotics, and in all of the technology that we use. And I think that's even getting better as we work on this energy transition. So maybe that's the second part of it is if they don't want to work in the oil and gas industry, we are rapidly changing. I think at least as you hear the three of us talk about a lot of stuff, most of us are around pipelines, and the U.S. has more pipelines than any other place in the world. And we may not be transporting crude oil in a few years. We may be transporting hydrogen. We may be transporting something else that has to do with this energy transition. And we've got the infrastructure to do it. So I think it's a great time for people to join the industry if we can just convince them it's the right time.
Okay. Hey, Juan, got some thoughts?
Yeah, I think AJ hit it the nail right in the head. We are an extremely cyclical industry. And obviously morale in industry-wide kind of goes with those cycles. When I first came out Lamar 10 years ago, it was, oil and gas was very sexy. We all wanted to go to oil and gas, right? And as a matter of fact, out of my graduating class, most of us went into oil and gas. And now, because of reputation and because maybe the opportunity for growth within companies isn't as clear as it used to be when the industry was booming 10 years ago, people are starting to look elsewhere, right? And it's not just the guys coming out of college, it's the guys that are, towards the middle of their career path. They're leaving, right? They're leaving the industry to go do something else. And so I think it's a big mistake, especially given the recent geopolitical environment. It's clear how important energy independence is, and it should be even more interesting for younger people to come into the industry and join us, right? It's important for everybody, right? It's vital. And like AJ said, it's incredibly high tech. There's really cool things happening. And we need to do, as an industry, we need to do a better job at communicating that and at showing that. I think that's where I stand on that.
Okay, Greg, what do you think?
Yeah, I can chime in too. I mean, the question all the younger generation is asking, right, is am I going to have a job in 10 years? Am I going to have a job in 15 years, right? That's the message that is being pushed on the younger generation in college in their 20s, that the industry is dying, that we don't need energy, we don't need oil, we don't need gas for many more years, and that everything's switching to green. And that's just not necessarily the case. I mean, there's a reason why Juan and myself and other younger people in the industry are here. I mean, we believe that there is runway to grow and have a full career and not have that career cut short by some cutoff in the future that all of a sudden we're going to switch to a fully renewable world, that's just not the case. And as we switch from this high growth mode that the industry had the last few years or the last decade, it's a more of a kind of cash flow generation kind of comp, honestly, is an issue for younger guys as well. That when you're looking at different industries that are in high growth tech, where you're like, I can have a 10 bagger, a 20 bagger, like they have these grants, they try to chase these carrots. And as in a more mature industry like ours, we just need to be more thoughtful, I think, on how do we appropriately compensate younger generation to stay and want to work and grow their career in this industry versus chasing some type of rapid growth company. And how do we level set those two things? I mean, because as we can talk ideologically and everything else, like comp is an issue. And when you're looking at, hey, I can get an equity grant from a tech startup that could be worth 20x in 5 years, right? We just need to recognize that is an issue that we need to face as well.
Okay. Gentlemen, I have a couple of tangential questions to this topic. We're going to touch on these questions more depth in a few minutes, but let me go ahead to the panel. Do you see this issue of attracting and retaining young talent as having an impact on industry capitalization? Any takers?
Well, I guess I can start because, when we talk about capitalization, there's of course the financial piece, but I think since we're talking about young talent, our capital is our people in a lot of ways, because again, as we go back and we talk about the technology, and we have to have the people that are going to implement it. And, we've got a huge number of really smart people in this industry, but we have to continue to bring in new people and new ideas. I mean, the stuff we do these days is so different than what we did, 10 or 15 or 20 years ago. And so much of that is based on the fact that new ideas are constantly coming in. And that's the real reason to bring in the younger talent is to be able to feed a lot of that.
Okay. Another tangential question to this issue. Energy transition was brought up about how the assets could be used for hydrogen or whatever going down the forward. Is there any can you expand in that in terms of opportunity and retaining and attracting young talent, energy transition?
So I can chime in on that. I think a lot of the bad reputation that the industry has right now, which is slowly getting fixed, by the way. I don't want to be overly pessimistic about it. Has to do with greenhouse gas emissions, right? It's not a secret for anybody, right? On the social side, sure, there's things that we can work on, but so do banks and other industries, right? But for our industry, the main culprit or the main subject of the bad reputation is greenhouse gas emissions. And so this energy transition, what we're living right now in the industry of getting greener, getting more sustainable, reducing emissions, right? Keeping those molecules trapped instead of doing everything possible to reduce flaring and venting. All those things go aligned with what the younger folks are looking for, right? Which is a more sustainable environment, a more sustainable world, a more sustainable society. I think the industry is working really, really hard. I can tell you because I'm at the forefront of that effort at Summit, and we're working really hard to make it happen. And we need new ideas. We need new people to join us in that.
Okay, thank you, Juan. Let me ask this now. Aging infrastructure, that's talked about a lot, and if we may get to that topic in a little more depth, but do you guys see the aging infrastructure? A lot of our pipelines are 50 years old. There's a lot of technologies that are out there that are being brought to bear. Do you see that as being a factor in attracting new people to the industry, aging infrastructure and opportunities that are frankly going to go with that? This infrastructure will stay with us.
Yeah, Tom, I'll take that one. I mean, as production has shifted from a lot of these legacy areas to shale in our country, I mean, there's a ton of infrastructure that is highly underutilized throughout a lot of these legacy basins, and I think that goes back to a perception issue. It shouldn't be viewed as a negative. It's a positive. This footprint that the industry has can be repurposed and can be utilized for a variety of aspects going forward, right? Replicating some of this is not cost effective. You can utilize right-of-ways. You can utilize a lot of this aging infrastructure and alternative services for things even totally outside of the energy industry, honestly, that the footprint is so valuable, and the connections, and it's such a head start on doing anything greenfield that there's a huge untapped opportunity that the industry is just now starting to explore on how best to monetize. And it's just kind of a dormant revenue stream that's sitting there that is going to take, honestly, it's going to take some work. It's going to take some R&D. It's going to take some digging to figure out how best to repurpose a lot of these assets and kind of extract that value going forward. But that's a whole different side of all these companies that are forming teams to explore just that option.
Okay, thank you.
Yeah, I mean, I think everybody's worried about all this aging infrastructure, but the bottom line is we continue to need and build more of it. I know that you can talk about a 50-year-old pipeline, at least those of us in the industry, we feel comfortably fine that we've done all the inspections, we've done corrosion protection, we've done cathodic protection to keep these things running. And when you look at the efficiency of using the pipeline network, just one crude oil pipeline. I don't, it doesn't matter if you're for or against, something like the Dakota Access or the Keystone or whatever, but we take thousands of trucks off of the roads in order to, by using a pipeline to transport that crude oil. And just from a safety and efficiency standpoint, that's just very necessary. And I think people don't give us enough credit for that.
One final tangential question on talent, the talent discussion. I think AJ brought up technology, robotics, and things like that. You don't have to go to Google and Amazon to find incredibly large investments in technology and development of technology and application. One that comes to mind for me whenever I think about midstream and transitioning towards more utilizing more technology is digital transformation. Huge amounts of data are gathered now. It's very inexpensive to do it. The problem is, how do you convert this information into actionable information that people can make use of? Do any of you guys have any thoughts of to explore in a little more depth technology applications and I guess in particular digital transformation in the midstream industry?
Take a stab at that. Data is everything, right? I mean, the improvements we can do with data, the progress that happens, the biggest leaps in technology come from an abundance of data, right? Right now, we're at the spot where we figured out how to collect it. A lot of it, we have it. A lot of people have it, and we're starting to figure out what to do with it, right? So I think there's a massive opportunity, especially for, we're talking about younger talent, for those engineers that are into data analytics, right? And even on the finance side of things, of how to utilize that data to better your business. There's a massive opportunity, completely untapped right now, almost completely untapped. And I think the industry is absolutely starting to realize that right now.
Okay. Well, thank you very much. I often tell people that who really aren't that frankly well informed about the industry, about our application, and the very large numbers of dollars that are put into data to technology and brought to bear in this. And so it's not your grandfather's industry anymore. It really isn't. It's very much technologically and information driven industry. Okay, we'll move on to the next topic of the day, which is capital markets. Greg, kick us off. How have capital markets shifted, and what's the impact on midstream companies and industry behavior?
Sure. Thanks. I'll start with that one. If you look back to the start of the shale development back 15 years ago now, I mean, the midstream industry was in significant growth mode for a long, long time. There's the traditional GP/LP structure that much of the industry used, which works great as you're growing, you're raising equity. I mean, there were equity issuances almost daily. Companies had ATM programs constantly tapping the equity markets to grow. There was almost an uncapped pool of money that was willing to invest in the industry and grow the industry and spend money and build projects. Unfortunately, the result of all that was that there was an overbuild of infrastructure in the US, specifically in a couple basins, and the COVID pandemic really exacerbated that problem with the production reset. And we really showed that the returns weren't there. We have to be honest that I mean, all that spending resulted in returns on capital under what many in the industry hoped for and what these investors were hoping for when they got into investments in these companies. And so COVID really accelerated a shift to a total new way of thinking that many in the industry have adopted to operate your business within cash flow. Their equity issuances are extremely rare. Got rid of the old GP/LP model, which doesn't really work in a more mature cash flowing business. And the focus and what investors want now is free cash flow yield, right? I mean, the shift from a growth to mature in the industry, I mean, it felt like it happened almost overnight. I mean, COVID quickened that pace so drastically. And so now it's all about being responsible with your capital, responsible with your capital allocation, and generating cash for the unit holder and for the shareholders. Because at the end of the day, we have to realize that we struggle with terminal value. Everyone in the industry, to support what Juan and AJ said already, that energy transition and in the future, the oil industry is questioning what the duration of these cash flows are, and so the pressure to generate cash and return cash to unit holders has been stronger now than it ever has been.
Okay, Juan, you have some thoughts on this one?
I do. Yeah, like Greg said, look, it's no secret that the industry's had roughly 10 years of negative returns. And so to any investor that's looking to allocate capital out there, man, they're going to think about it really hard, right? Especially if you combine that with the narrative and the reputation side of things, man, they start thinking about it, right? And so when we have, possible projects, capital projects, we really have to grind right now to get that capital. It's available, right? But I can tell you that if you present an investor with a traditional oil and gas development and renewable energy development, maybe that renewable energy development is presented with maybe even lower returns, but they're gonna be inclined right now to send the capital over there, just because the markets trade on narrative, right? And they're a little bit more emotional than rational. But I think it's just part of the free markets, right? Right now, we're paying the price of 10 years of negative returns. And I can tell you that the number of oil and gas companies, not just in the midstream service area, that have been for the last 18 months to 24 months in balance sheet repair mode is vast. I mean, like Greg said, we're figuring out how to be lean, how to be productive, how to be less wasteful. And eventually capital will realize that. They will see that, and capital will come back, and they'll see that it's a cash flow business, like Greg said. So I think that'll level out in time. They will also realize with all these renewable energy projects that they're not all as pretty as they paint them, right? Just like Shell, like it happened with Shell Oil, 15 years ago.
Thanks. AJ, thoughts?
Yeah, I mean, I agree with what both Greg and Juan have said. And earlier on, we talked about the cyclicality of the industry. We have probably destroyed value in the last few years because it was pretty easy to go up to a banker in Houston and get $300 or $400 million without really having a whole lot behind it. That's gotten a whole lot tougher, but maybe that's a good thing, because now, as Juan pointed out, and as Greg pointed out, free cash flow is becoming more important. And so what are a lot of folks doing? I mean, they're actually going out and buying their own stock. When you look at the Chevrons and the Exxons and the Shells and the BPs of the world, they're spending billions and billions of dollars to buy their own stock, which at least says they think it's undervalued and whatever. So with the cyclicality, look, the capital will come back into our industry. We just have to prove to the people that are out there loaning it that we're good stewards of that capital. Like Juan said, some of those sexy renewables projects aren't going to come out and be exactly what they thought they were. And all of a sudden, at oil at $110 today, when you were drilling at $60 or $70, those wells are looking really, really good. Really? The problem with our industry is we chase those oil wells at $110 a barrel, and we don't go chase them at $40 a barrel when we should be.
Yeah, that makes sense. So, guys, do these capital market shifts impact society's energy transition goals? Is there impact there? Anybody want to pick that one up?
Yeah, I mean, I think there has to be, right? Because again, everybody wants to go do all these nice renewable projects. I think one really interesting point is it's going to take all of the above for us to meet our energy needs. I mean, we can't just automatically switch to renewables, but at the same time, we can't get away from hydrocarbons. And while we tend to concentrate on all of the transportation fuels primarily, don't forget that a huge amount of the hydrocarbons also has to do with plastics and medicines and all the other things that go along with it. So even if we go to 100% renewable electricity, we still got to make plastics. And I think that's what's probably going to help the cyclicality and the cash infusion and the capital eventually, is we will move away from transportation fuels and relying on hydrocarbons for transportation fuels, but we'll go more heavily towards plastics and all the other things we can make out of it.
Okay, thank you.
Yeah, I would almost invert that question and say that a lot of the energy transitions goals by a lot of these institutional investors are impacting the capital markets for midstream and limiting the investor base. I mean, there's been a full turnover. It seems like not totally, but the traditional institutional investor base has shrunk dramatically. And many of much of the activity in midstream now are funds, hedge funds, and other more short-term trading vehicles, not long-term institutional holders. Right, that's been a huge pivot in the industry over the last few years, and a lot of that is driven by the standards and the mandates that a lot of these institutions have and what they're allowed to hold based on these long-term ESG goals that they have.
Okay.
If I can just add to that just a little bit, because I think it's important. That last thing Greg said, long-term ESG goals, right? They're long-term. These things can't happen overnight, right? We've been addicted to fossil fuels for, decades, right? So we can't shift that overnight in a year. It's not going to happen, right? It requires, first of all, a lot of cash, a lot of investment, right? And second of all, it requires time, right? It requires infrastructure to be built. Infrastructure doesn't get built overnight. It takes a lot of manpower, it takes a lot of cash, and more importantly, it generates a ton of jobs, right? And I think we're better positioned than anybody to adopt that energy transition or to aid that energy transition, but it's going to take a long time. And so all those funds running away from oil and gas because they don't align with their ESG goals are forgetting that those goals are long-term. They're not goals that should have been adopted yesterday, right? We're all working on it. You won't find anybody, as AJ said, that's going to say, oh, this energy transition thing is a bad thing. No, we want it. We just can't do it yesterday. We're working on it. It's a slow process. It's a transition, and in order for that transition to be effective, we need a reliable source of affordable energy. Otherwise, there's no capital for it, right? We need affordable energy to make that transition happen. And right now, the affordable energy is here.
Okay. Now going a slightly different direction on market shifts. Do you guys have any thoughts about public versus private companies, large versus small companies in the capital market shifts? Is there any separation here?
Well, it's always been generally easier for the larger companies to get the capital, and that's probably always the case. A few years ago, it was very easy for the private companies to get it because, again, bankers just wanted to throw money at it. So I think what's happened is now it's been harder for the smaller companies to get it, and it's probably harder for the private companies to get it. So we've had a shift back into the balance sheet financing versus debt financing on a lot of projects.
Do you think that's going to lead to the private and or smaller companies getting consolidated into the larger public entities? Do you think that's the future?
I think that's always an interesting trend. I mean, what was it, 2 days ago, Chevron announced they were buying a renewable fuels company for, I think, $500 or $600 million. So I think you will see some of the innovators out there when you've got, very large companies that do have cash on their balance sheet, especially $100, $110 oil. I think they're going to be out there. They're going to be selective, but I think they're going to be out there getting some of those companies.
Yeah, no, I mean, I think consolidation is the future, but honestly, I mean, I'd say on a wide scale, I mean, the E&P consolidation wave is way ahead of the midstream consolidation wave, right? I mean, there have been large deals announced for the past 2 years, whereas there have been very few midstream kind of M&A transactions announced in the last couple of years. And a lot of that is just the kind of the bid-ask spreads on these buyers. They're just still too wide to have a successful negotiation. And at some point, the valuations need to settle out to where, yeah, consolidation is going to make sense. Cost cutting and getting lean and operating in this new paradigm that we've talked about is the way of the future. It's just we're not quite there yet as an industry.
Okay. I'll go on to a final sort of question I have on this capital markets focus. What about, do you see a difference or a preference for oil or liquids versus natural gas focused midstream companies? And also, to take that a step further, do you see regional preferences or effects of the shifts in capital markets? Anyone?
Yeah, I mean, I can start on that. I mean, I think it's pretty clear in the market that companies that are better positioned to play in this energy transition space are getting a preferred valuation, specifically natural gas weighted companies and more long haul pipeline entities versus smaller gathering entities. I think kind of crude oil levered companies that are viewed as kind of not having as many cards to play, potentially rightly or wrongly. I think that's the view in the market, and that if you're a liquids entity, you're getting a discount. If you're more levered to gas and NGLs and kind of a different petrochemical industry, that it's viewed as a little bit longer of a tailwind. But just in terms of perception in the market, I think that it's pretty clear that's what the market is telling you.
What about regional effects? Do you see that out there? Is there a preference in capital markets for different regions? Any thoughts?
Well, I mean, I think the last couple of years, people have been putting a lot of money into the Permian. I mean, you go back 10 years, and of course, the Marcellus, everybody was up there. It's still a pretty good area to drill, but definitely the Permian has become hot again, which is interesting because back in the late 80s, everybody was trying to run out of the Permian, and of course, like everything else, it's been rejuvenated.
Okay, well, let's go on to the next topic of the day. Juan, what role does the midstream sector have in energy transition?
Well, like I said earlier, I think the midstream space and a lot of oil and gas in general, let's remember that we're energy companies, right? So I would say that we're better positioned than anybody else to lead the effort in the transition, right? I think that's where we're at. That's where we fit. We have the experience to operate these facilities, to build them and operate them, right? Better than anybody. I've actually talked to a couple of traditional EPC, oil and gas EPC companies that have shifted, because the business is slow, that they have shifted to building solar fields and renewable facilities or renewable sources, and they're killing it. They're awesome at it, better than all the traditional guys in that industry, because it's building gas plants and refineries and pipelines, that's not easy, right? I mean, the people who are doing that, they're very knowledgeable in construction and engineering. So when they go to these renewable projects, they kill it, right? They're on time, under budget. They're better than anybody else trying to do it. And so I think we're better positioned than any other industry to lead the effort in the transition. I think that's where we fit.
Okay, AJ, thoughts?
Yeah, no, I very much agree with Juan. I mean, it's interesting because again, we have the technology, we have really smart people, we have the ability to do some of these things, and everybody seems to think that we're against all the energy transition or against renewables. And everybody, all my friends in the energy industry or oil and gas, I would say exactly the opposite. I think we understand that we need a lot more energy as the world's population grows, as standard of living increases in many places around the world. And heck, we can't meet all of that demand with oil and gas. So we need the renewable, and there will be a transition. I mean, maybe right now renewable is 10 or 15%, maybe that grows to 30 or 40 or 50%. But with the way that energy demand itself is growing, we need all of the above. And who better to lead than us?
Okay, Greg, thoughts?
Yeah, I mean, I just think it's just so early, right? I mean, it's just still so early in this development, and it's going to take many, many years to fully get the game plan together on how we are going to transition to a more renewable future. But every time you're building additional solar power or wind power, you're going to need to build additional gas plants right next door to provide backup. You're going to need to build additional pipelines to support that gas plant. I mean, it's going to require additional investment across the board to have a successful transition, or you're going to end up in situations that you do not want to be in, where you may have to turn the power out, right? Similar to what happened in Texas last year, right? You need additional investment across the board, and I think states and countries are starting to realize that, and that it's a bad day for everybody if we don't execute this successfully.
Okay, thank you, sir. A little adder question from me. An energy transition. It seems to me that it's going to drive. You guys have all touched on this a little bit. Drive asset rationalization of midstream assets and repurposing of assets. Do you think this is going to be a slow or a rapid rationalization or repurposing? And the ripples from those two things will extend through everything. So it's an open question. What do you think about these two aspects of energy transition?
I think it'll be slow. I think it'll be slower than most people want. It just takes time to do these things. And I think that the narrative on specifically this transition portion is disconnected from what's feasible. For example, let's say converting pipelines or traditional pipelines or abandoned pipelines to CO2, dedicate them to carbon capture. Yeah, that's great, right? We can do that. But then what do we do with that CO2, right? When we hear these things on the television or what our politicians say, well, we need to be doing carbon capture. If you do carbon capture, you get so many dollars per metric ton if you use it for this or for that. But then they forget to tell us that in the entire United States, there's only 2 approved Class 6 wells for carbon sequestration, right? So I think it's just going to be a slow process, right? It's going to take time because things have to develop on 2 ends, right? And then somewhere they'll meet in the middle, and real progress will start happening. But it's going to take some time.
Thank you.
I mean, it's going to take some time, but I mean, I think there is going to be a kind of an initial pretty strong wave here in the next 3 to 5 years where you're going to get a big initial push from a lot of these companies that are going to kind of announce their first big projects, whether it's CO2, whether it's hydrogen, that there's going to be a first wave. It's not going to make a huge dent in the scheme of things, right? When you're talking about large scale transition, but it's going to start here like very, very quickly. I mean, you're seeing everybody gear up. Everybody's figuring out what that first project's going to be. Everybody's trying to get that press release out, get those economics squared away. And a lot of it's going to be around CO2. I think a lot of it's going to be around hydrogen. There's clearly issues on transporting hydrogen long distances. I think that in terms of an R&D project and technology, that needs to be worked out. But in areas where you have the supply and the demand of hydrogen, there's projects that are going to be able to be pursued and successfully executed here. I would say within 3 to 5 years that you can start seeing hydrogen hubs pop up and CO2 projects pop up to where you can execute those. Yeah, they may be regional, but they're going to grow over time and to make a huge dent in kind of what Juan was talking about in the global landscape. Yeah, that's long, but I mean, you're going to see action here quickly by the industry. Like the industry is not just sitting on its hands and slow playing this. I mean, I think you're going to start seeing more and more announcements come out here pretty soon.
Yeah, I mean, I think you will, and I think rationalization and repurposing will go relatively quickly. I mean, we do have some technological issues that, like we just mentioned. You know, we can't just necessarily reuse all the exact pipelines in the same way. You know, CO2 has corrosion issues, and we're gonna have metallurgy issues with some of these. But look, again, we'll find ways to do it, and I think it'll be easier for us in the industry to find ways than probably to go build a lot of new infrastructure, because right now the environmentalists don't want us to build anything at all anyway.
That's right.
It makes me wonder, all the different groups pulling in different directions, and there's a lot of arm waving going on. And I wonder how much of the arm waving is a matter of what I want to call propaganda ministers for various groups, or how much of it is real and what's going to happen. Because at the end of the day, things have to be profitable. If they're not profitable, they die. That's just fact of life. We have some time here, so I want to just see if we can touch on aging infrastructure. AJ, it's an open question. How does the fact of aging infrastructure fit into the future?
Well, one, again, you know, in the United States in particular, and definitely in North America, we have a huge amount of pipeline infrastructure you just don't see in other parts of the world. But of course, a lot of it's old. I mean, we've got a lot of pipelines that are, you know, World War II era that were built for basically for the war effort. The good news is, I mean, look at the companies that you've even got here, you know, here on this call. We've taken pretty good care of the infrastructure, and now we have, you know, inline inspection processes, corrosion. We've done we have a better technology to be able to look at all that stuff. So I think when we talk about the infrastructure, the first thing is physically where it is, and then secondarily, what shape is it in? So there is a little bit of a mismatch in terms of where it sits, because the production areas in oil and gas aren't necessarily the same as where all the population centers are. I mean, we look at what happened in the Northeast with the Marcellus as we built that out. But then the good news is we have the ability to keep that infrastructure in good shape. And again, I think that's something that the general public doesn't really understand very well.
Greg, any thoughts on this one?
Yeah, I mean, I think it's a topic that doesn't get discussed very much, but I mean, every large midstream company in the U.S. has a huge part of their business that is managing kind of legacy assets that don't get headlines, that aren't growth vehicles. They're in the Gulf Coast, they're in the Mid-Con, they're on the West Coast. They're in areas that used to have a lot of production that are just not that prolific anymore for a variety of reasons, right? And what do you do with those low flow situations? Do you shut them down? You're going to operate it safely no matter what. If you're operating, right, so you're going to spend the money, but a lot of this infrastructure, like it's not economic. So what that does is it forces conversations with producers. Like, they don't want their production shut in. But they also don't want to pay more necessarily to transport their products, right? So there's that give and take. And eventually what needs to happen is kind of consolidation on a lot of these legacy areas, to where I can shut down this pipe, we can consolidate volumes on this other pipe and continue to serve the customer, which is a good thing for everyone. But I mean, those conversations happen all the time, and it's a lot of pipe, right? It's a lot of assets. It's decades and decades worth of infrastructure development that needs to be managed. And yes, there's opportunity in terms of right away and repurposing that we've talked about, but there are real challenges in time and focus that a lot of these companies have to undertake to decide how best to shut down a decision at the end of the day. Do you shut it down, or is there some other way we can do, other path we can take to monetize these in some fashion?
Juan, thoughts?
Yeah, no, I'm completely aligned with Greg there. I think it doesn't get touched on enough, and it comes down to dollars, right? It has to be profitable. The amount of money that a midstreamer has to spend on integrity for these laterals, these flow lines that connect to depleted wells, is a lot, right? So the volumes coming from those wells have to match the money that you have to spend on integrity. Otherwise, you have no option but to shut them in, right? And so like Greg said, there's the one solution that a lot of us are finding is how can we consolidate some of those low flow producing wells into one line instead of having 10 laterals, and reduce that spend on integrity, safety first, right?
Yeah. Okay. Well, thank you. As we've gone through these various topics of the day, one thing it just is very clear is that they're all related. It's kind of like a Venn diagram. They all overlap. They all interconnect. It's really hard to have a conversation about any one of them without drawing in the other elements. I mean, it's a complex discussion, and you know, saying taking an hour to do it doesn't do it justice. Every one of these can be dealt with in much more detail. But today was a survey of these discussions. Fellas, while we were talking, did anything come up in your that you or that you thought was missed, or do you have any final comments before we wrap up for the day?
Maybe I have one little remark before we say goodbye, and is society as a whole, we need to stop making the energy transition such a political topic, right? It's toxic. It doesn't lead anywhere. We all want it. Doesn't matter where we stand. It's good for everybody, and we all need to be positive about it, and we need to see how we can work. And to the younger talent looking to find a spot in the workplace somewhere, I would encourage them to consider this industry, because that's where we're headed. So if you want to be part of that change, if you want to be involved in making the world more sustainable and our energy consumption more sustainable, this is a great place to start.
Yeah, my takeaway would be, I mean, that the future for midstream in the U.S. is very, very bright long term. I mean, and the situation, the very unfortunate situation with Russia and Ukraine, is highlighting the how critical the industry, the broader oil and gas industry is to the global economy, and it will be for a long, long time. And so I hope the industry can be highlighted to the younger generation and show that it's a great place to work. It's a great place to add value. I mean, you're doing real good for society in general in terms of raising standard of living, raising quality of life across the globe. I mean, and that's the message that the industry really needs to pound the table on as publicly as it can.
Yeah, I mean, the people that even enter the industry now, you know, it's still going to be here in 50 years. So they shouldn't worry about the longevity of their careers. It will, there'll be plenty of things to be doing. It's going to change, just like for most of us who've been in the industry for a while. What we're doing now is not anything close to what we probably would have imagined 20 or 30 or more years ago. But we're still here, and we're still going to do really neat projects, high-tech projects, and you know, there's still a lot of neat projects to be working on.
Thank you, fellas. For everybody, listeners and watchers, viewers today, I want to mention that last fall, we did a survey on the top 10. We're looking for the top 10 issues facing the midstream industry in 2022. We got about 18 issues, and then I asked the survey participants to force rank them, and we chose the top 10. And we listed them along with, in their forced ranking, along with some of the discussion around each of them. That paper is published. It's on our website at lamar.edu/midstream. I actually think it's interesting. One thing I'll note is that the top 8 elements, there was general consensus on, and beyond the 8, it's sort of, there was a lot of variation among what people thought. One thing that sort of surprised me, and I guess it shouldn't have, but it did, was number 2 on the forced ranking was attracting and retaining young talent, and that tied in with the narrative wrapped around the energy space, the energy industry. So take a look at that. I think you'll probably find it interesting. It's a short read. So Juan, AJ, Greg, We're at the end of today's webinar. The Midstream Center for Management and Science at Lamar University thanks you for your participation today. We appreciate it. To our viewers, we greatly appreciate your attention, and we're hopeful that this discussion delivered value to you. Be on the lookout for an invitation to our next webinar in the Midstream Center's 2022 series on this industry. Be well, everybody, and have a good day.